All right, everyone. So, where next for the Japanese yen in 2024 is a big question a lot of people have been asking me because I was trading against the Japanese yen last year, making a lot of money for trading the dollar, the pound, the euro. But now the whole situation is changing where they're predicting a very strong Japanese yen in 2024. And it's all because of the interest rate expectations from the Bank of Japan and other central banks around the world, like the Bank of England, the Federal Reserve, and the European Central Bank. So what the markets are looking at is interest rate cuts from these central banks, and finally the Bank of Japan raising interest rates, and that's going to cause, they're saying, some of the biggest moves in the Japanese yen in 2024. So if you don't understand interest rates, you don't understand the bond market, you don't understand how central banks are driving currencies, I'm going to break down for you why I'm trading the Japanese yen in 2024 and why you should definitely be trading the Japanese yen if you're interested in trading currencies or you already do trade currencies, as this video is going to be very eye-opening for you on the fundamentals and macroeconomics behind the drivers in the currency market. So enjoy the video, please like, comment and subscribe, and let's see where next for the yen. Okay everyone, welcome to this video. I'm going to touch on the Japanese yen and why this year the currency could be the best performing currency in the forex markets based on the Bank of Japan finally raising interest rates while other central banks start cutting interest rates, and this divergence in monetary policy could give some incredible trading opportunities for the Japanese yen. Okay, so what we have to understand is what happened in 2022 going into 2023 when central banks around the world started raising interest rates because of the high inflation situation that was apparent after COVID and when oil prices rallied higher. Okay, so what we're going to look at is we need to first of all pay attention to the inflation situation that happened in 2022 after COVID. Okay, so inflation got out of control, and you can see that in 2022, if you're looking at the United States, for example, in January, inflation was at 7%, way above the central bank's 2% target. Okay, Japan at that time had very low inflation, and Japan has had a deflation problem for over 30 years since the 1990s. Okay, and you can see over here, I just got this thing up about the chronic deflation in Japan that they've been experiencing since the 1990s. Okay, so they've had declining prices since the mid 1990s in Japan. So inflation hasn't been able to hit the central bank's 2% target. So Japan has had low interest rates for a very, very long time. Okay, so you can see when we're looking at that picture of the United States in 2022, inflation was at 7% in the US, inflation wasn't even at 2% in Japan. So interest rates in Japan were very low, whilst interest rates in the United States started to go up to try to get inflation back down to 2%. So why would the central bank be raising interest rates? Well, just think about it. As interest rates go up, mortgage payments go up, credit card payments go up, student loan payments go up, business loans go up, so people's spending gets reduced, and this is how you bring down inflation, because people can't spend as much money, so prices of goods and services start to go down because demand goes down. Okay, so you can see the Federal Reserve started to raise interest rates in exactly it was March 2022. So if I take you over here and I show you when interest rates in the United States start to go up, you can see over here March 22 is when central banks around the world started following the Fed and raising rates. 16th of March 2022. Okay, now what you'll start to see is the bond markets are the key driver for the currency market. So when the central bank started to raise interest rates in the United States in March 2022, which was here, which I just showed you, look at the dollar yen at the same period of time. So as interest rates on government bonds started to rise, because investors was obviously going to get protected from inflation because interest rates were going up, you could see money was flooding into the US dollar. And you can see that here because as the bond market starts to go up, as interest rates are going up in the US, okay, so you can look at March 22 until October 2022, rates went from 1.65%, which you can see on the right hand side, and it went all the way up to 4.2%. And look at the dollar at that exact same period of time. The dollar went up against the Japanese yen by 32% as the bond market was pricing in higher interest rates. Why was this? Well, as interest rates go up in the United States, it just means investors can get more interest when they buy government bonds. They couldn't get that much interest in Japan because if I look at the Japanese 10-year government bond, okay, in March 2022, look at the interest rate in the Japanese government bond. only paying 0.18%. Now, where would you rather put your money? In Japan paying 0.18% or in the United States paying you 4.3%? Big difference, right? So investors were selling the Japanese yen to buy US government bonds, okay? So Japanese investors we're talking about here. That dragged up, for an example, the dollar against the Japanese yen. And also there's something called the overnight carry trade, which I'm going to educate you on, which explains why when interest rates go up, currencies will strengthen or weaken depending on which currency has the higher interest rate, okay? So the Fed was raising rates aggressively. You can see in March 2022, rates are at 0.25%. And then by October 2020, when are we looking at? 2022, rates are now 4%. Okay, so the Fed is raising interest rates. Then why did the interest rate on 10-year government bonds in the US peak in October? And then we saw them decline until around May 2023. So you saw this decline in the 10-year government bond yield. Well, this is because inflation then started to come down, and the markets at that time were predicting that the central bank may start cutting interest rates, because you could see inflation had peaked in the US at 9.1%, but by October it had fallen for the first time for 3 months in a row. So markets were getting excited, thinking that the Federal Reserve could at some point start cutting interest rates. So you saw the bond market peak and then start to decline. But look what happened to the US dollar JPY as the interest rate on 10-year government bonds in the US were declining. Remember, interest rates in Japan didn't go anywhere. They remained where they were. Soon as the interest rate on 10-year government bonds started to decline, look what happened. The dollar against the yen started to decline straight away, okay? You saw the dollar weaken against the Japanese yen, okay, by around 10%. At one point, it was down 16%, okay? And then it went up a bit, and that's because the bond market had bottomed and then went back up again. So you see how the bond market is driving the currency markets. And then the markets realized that the Fed wasn't going to cut rates, and then bond yields went up even more, up to 5%. No surprise, dollar yen took off straight away around the same time when the bond market started to take off again, and the dollar went back up against the Japanese yen, okay, up to around 152. So with these big moves in the dollar's favor against the Japanese yen. And then now the markets have seen inflation come down considerably, okay, and in 2023 in the United States, we saw inflation go down from 6.5% all the way down to 3%. Core inflation, with strips out food and energy, went from 5.7 down to 4%. Okay, and because of the falling inflation, that is why the bond market now has started to price in the expectation that interest rates in the US are going to be coming down. That's why the dollar started to weaken against the Japanese yen during this period of time. Okay, can you see that the moves in the currency markets? So now you can see the bond market expectations of where interest rates are going is driving the currency markets. Okay, and you can see this actually play out throughout history. So what we look at here is, we can look at the history of the 10-year government bond in the United States, highlighted in blue, which is a difference between the US and Japan interest rate. So you take the 10-year government bond and the US 10-year government bond, the interest rate on the Japanese 10-year government bond, you look at the difference, which is the blue line, and the orange line is the exchange rate. Notice that when the blue line starts to go up, meaning the US pays more interest on their government bonds compared to Japan, look at the exchange rate. It rallies higher. And when they drop, as it's less favorable in the US, the currency pair goes down, goes up. It literally follows each other. You can see with the pound against the Japanese yen, same scenario. As interest rates in the UK go up more than Japan, so does the currency pair go up in the UK's favor. Or when interest rates are going lower, so less favorable for the pound, look what happens. The Great British pound against the Japanese yen goes down. You can look at for our history with the New Zealand dollar, the Canadian dollar, the Australian dollar. All the markets moving against the yen are based on interest rates. Okay, so as we've seen, inflation is falling in the United States. Now the markets are betting on rate cuts. Can you see? The markets are betting on interest rates to go down in the US. Markets are betting on interest rates to go down in Europe. Markets are betting on interest rates to go down in the UK. And because of these falling interest rate differentials between the UK, EU, Japan, the markets are betting that this trend, which we saw here, when the rates were going down previously in the bond market, will cause the currency pairs to reverse their trend and start to cause the yen to strengthen. And the other reason why is because now the markets are betting the Bank of Japan is going to start raising rates. So today there was a report. Bank of Japan edges closer to rate hike. Okay, you can see that. Here's another article. Bank of Japan to hold as markets seek hints on the inflation progress needed to end interest rates, negative interest rates, because Japan at the moment has a negative interest rate around 0. Okay, so what we're looking at, guys, if we're looking at the Japanese yen is, if you look at what's happening in Japan, so I showed you Japan has had low deflation for a very, very long time. Okay, but now look what happened in 2023 in Japan because of the high inflation that we had all over the world, as I'm sure you're aware. Japanese inflation for the first time in nearly 30 years got above 2%. And look, it's remained above 2% for the whole of 2023. Okay, and the Bank of Japan today has forecasted inflation to remain above their 2% target. And that's why the markets are betting now the Bank of Japan is finally going to start raising interest rates, okay? And the key for the Bank of Japan to start raising interest rates is what we call wage gains or wage growth, okay? And I can show you over here. Economists surveyed before the decision, this is today's decision, saw April as the most likely timing for the end of negative interest rates in Japan, and it will provide time for the central banks to assess the results of annual pay negotiations. Rising higher raises in wages are seen as a key element to securing a positive cycle of rising prices, so no more deflation and higher inflation, and wages feeds into economic growth. Because look at Japan in 1990, they had a $3 trillion economy before that 30 years of deflation, okay? The US at that same time had a $5 trillion economy, so Japan and the US has basically had the same economic growth, but then look what happened. By 2023, Japan's economy was only worth 4.2 trillion, basically hadn't grown, hadn't even doubled. The US in the same period of time went from 5.9 trillion to 26 trillion. So if you've got deflation, you've got low growth. If you have steady inflation, you get higher levels of growth. Now, for the first time, investors are betting that Japan's economy is going to start growing. And the reason why I was just explaining to you about wages is because what investors are looking at is if people in Japan are now demanding higher wages because inflation has finally gone above 2%, businesses are going to be forced to pay higher wages to their employees. Otherwise, they don't want to lose them to their competitors. And then to offset the higher cost of paying wages, they raise prices and you get an inflationary spiral and cycle starting to come into play. And when you got steady levels of inflation, you get higher levels of economic growth. Okay, so this is now where interest rates start to play into the facts of a stronger Japanese yen, because if you can understand the overnight carry trade, this is where you can really understand what drives the currency markets. The reason the US dollar went up by 36% against the Japanese yen was because interest rates in the US kept going higher, okay? Now, if you are selling the Japanese yen to buy the US dollar, which you have to do if you're buying the dollar against the yen in a foreign currency pair, the interest rate paid by the US central bank, which at the moment is around 5%, okay, if that interest rate is at 5% and the interest rate in Japan, which is currently 0.1%, which means if I borrow the Japanese yen to buy the US dollar, I get charged no interest on the yen that I borrow. But if I buy the dollar and the interest rate in the United States is 5%, then I'm going to make 5.1% free interest. The broker's going to credit that into my trading account over 365 days, which means if I'm a hedge fund or a big investor with a big amount of capital, and let's say I take 100 lots position for an example, or 1,000 lots position, I could be making 15 grand a year credited into my trading account, free money basically, because the interest I get paid for the dollars I've purchased is making me money even if the exchange rate doesn't even move, and I pay no interest on the Japanese yen. Hence why, as the interest rate in the US kept going higher and higher and higher, investors was chasing this free money, causing a 35% move in the dollar against the Japanese yen. And as soon as the interest rate markets were expecting rate cuts, why do you think you get such sharp moves lower? Is because investors who have made a 32% gain on their money, soon as they know that 15 grand a year interest getting free credit into their trading account by the broker is going to come to an end. And let's say interest rates go down in the US, say 3%. Now look, that free money is only now 8%. So you would want to lock in that money off. You'd want to lock in that trade where you've made a 32% return, right? Otherwise, if you wait until interest rates go down, everyone's going to close that trade quickly. And now you've only made a 12% return on your money on the currency pairs move. So because the markets are expecting interest rates in the US to go down, so where do we see interest rate going in the United States? We see rates going down in the US by the end of this year to 4%. Okay, so that means rates will be at 4% in the United States. And rates in Japan are expected to go to, at the same time, okay, let's just close these spreadsheets. Where are rates expected to go in Japan? Okay, we're looking at the interest rate differential. So markets are betting in Japan interest rates to go to, by the end of the year, 0.2%. So look, 0.2%. So remember we looked at that 14,000 credited, now it's going to go down to 11,000. Hence why the markets are betting on a stronger Japanese yen. So what do we need to see rates go down in the United States, which is key? Well, the markets are looking at inflation, obviously. That's the key for the United States. Where is inflation going? So if we, like we saw last year, inflation continue to come down in the United States, then the markets are going to be betting on rate cuts in the United States, as I've shown you over here. Okay, and if the markets are betting on rate cuts in the United States, as you can see here, then you know that's going to be priced into the bond market. And if we see the interest rates on government bond yields coming down, as we saw here in October, and look what happened in October when the yields were coming down, the dollar got weaker. If that yield keeps falling, you know what's going to happen. As you saw over here, the yen will get stronger against the US dollar, but not just the US dollar. Look in Europe, markets are betting on the euro to weaken against the Japanese yen, because the markets are also betting on what? Rate cuts in Europe, sharp rate cuts in Europe. So we can sell USD JPY, we can sell euro JPY if the interest rates in Europe start to come down. Notice again, look, as the interest rate differential was going down on the bond market, you can see that's when the euro started to weaken against the yen. So we're looking at rate cuts in the UK, rate cuts in Europe, rate cuts in the United States, and higher interest rates in Japan. So you already know, guys, how to trade the yen. We need to focus on the fundamentals driving markets. If we're not focused on the fundamentals, such as where is inflation going, where are interest rates going, we can't trade the markets professionally, guys. You won't even know why the US dollar is going lower against the Japanese yen as these interest rate cuts come in the US, as the bond market starts to show you bond yields going down. You won't even realize the moves as they happen because you don't understand the fundamentals driving the markets. That's why we have to pay attention to the fundamentals. That is key. So I'm going to be trading this throughout the year. I'm anticipating to make a lot of money trading this currency pair with my VIP members. If you want to come and trade with us, get these macro fundamental updates on the markets to understand how to trade currencies, come and join the free Telegram channel, get some updates. If you want to come and join the VIP members and trade alongside me, you are more than welcome, guys. Okay, get educated on fundamentals. It's key. Otherwise it makes it very, very difficult to trade the markets. Here, guy, hedge funds turn bearish on the dollar. Why do the hedge funds are now selling the dollar? Why are they doing this? Because of expectations that the US central bank clear a sign that interest rate cuts are coming. So there you go, guys. When hedge funds are selling the currency, you need to be selling the currency, and you already know why they're selling the currency, because interest rates are going down. As I explained here, that's why the bond market was going down at this period of time, which was pushing down the dollar against the Japanese yen. That was at that period of time, markets are betting on rate cuts, and they're betting on rate cuts again, and that's what will drag the currency pair lower. Okay, guys, come and get involved. Come trade with us, and let's trade the yen. Let's make some serious profits.